Hi everyone, this is Jakub, your market analyst at eToro, and welcome to a new episode of Stock Break, your weekly opportunity to dive into public companies as we break down their business, fundamentals, and valuation. Please remember that this podcast is intended only for educational and informational purposes, and stay tuned for additional disclosures at the end of today's episode. Do you know who's been the biggest beneficiary of Europe's spending push? You might think it's Lockheed Martin or Raytheon, but the answer actually lies much closer to home. It's Rheinmetall. This German arms manufacturer has seen its stock skyrocket as Europe races to rearm. But after such a massive rally, the question is the growth already priced in? Welcome back to another episode of Stock Break with somebody that you are seeing for the first time. My name is Jakub Rochlitz, I'm your Czech market analyst at eToro, and today we are diving into Rheinmetall, the defense giant powering NATO's armies. We'll break down the fundamentals, look at the explosive growth, and check out whether this stock still belongs on your radar. Quick reminder, this podcast is for educational purposes only. Nothing here should be taken as investment advice or a recommendation to buy or sell any financial instruments. If you're not yet subscribed, make sure to hit the subscribe button and check out our channel for more stock analyses. Rheinmetall is Germany's largest defense manufacturer and the go-to supplier for NATO standard equipment. If it shoots or gets shot, there's a good chance that Rheinmetall makes it. We're talking everything from tank shells and anti-aircraft systems to armored vehicles and battlefield electronics. The company operates across 4 main divisions, but 2 of them drive more than 65% of sales and the bulk of the profit. These are weapons and ammunition and vehicle systems. Think Leopard tanks, Panthers, all the ammo you can imagine, or futuristic drone defense systems. Rheinmetall is behind much of that. Germany accounts for about 30% of revenue, but Rheinmetall's reach goes far beyond the country. Nearly half of Rheinmetall's revenues comes from other NATO allies across Europe, giving it a diversified customer base. What's more, many of these contracts are long-term framework deals. This means that rather than one-time delivery, governments can draw down equipment over several years, basically telling Rheinmetall, we are going to buy from you in the future, so make the space. As of right now, the company's backlog is over 6 times its 2024 revenue, with more than half already locked in as confirmed orders. Bottom line, demand is not the issue. The real challenge is scaling up production fast enough to meet all of this rising demand. Rheinmetall operates in a crowded European market with competitors such as BAE Systems, Leonardo or Saab. But its German roots give it a home field advantage. EU defense spending is increasingly local and Germany has one of the deepest pockets. Hundreds of billions of planned spending will go to Germany's defense capabilities, with Rheinmetall positioned to take a large chunk of it. Still, this is a capital-heavy industry. Margins are improving, but net profits remain fairly modest and Rheinmetall has to invest into capacity expansion to drive real growth. And that's costly. So, let's talk numbers. Rheinmetall is in solid shape. It's got an investment-grade credit rating, healthy cash flows and manageable debt with a debt-to-EBITDA ratio of 1.06. The company is using leverage smartly to fuel growth, building new factories across Germany, Latvia and Hungary, and making key acquisitions. Margins are trending up thanks to pricing power and a favorable product mix, but these are likely cyclical tailwinds, not something that's permanent. The dividend is tiny at 0.41%, but that is expected for a company in full expansion mode. But here is where it gets interesting. Despite the recent pullback, the stock has already surged more than 170% this year, and multiples have more than doubled versus historical averages. Analysts love it. It's got 16 buys, 3 holds and 0 sells, but much of its growth comes from multiple expansion, not earnings growth. And that's dangerous because high multiples equal high expectations, and high expectations leave little room for error. Unless defense budgets increase further or geopolitical tensions escalate, the upside could be capped at the current prices and we could see the stock trading sideways. And there are real risks. Manufacturing delays, de-escalation intentions or political oppositions to all of this spending can hit sentiment fast. And we've just seen it with the share price reaction to the EU-US tariff deal or the recent ceasefire talks. So, is Rheinmetall still a buy? It's a great company, no doubt, but at these prices the market's betting on smooth execution and continued tailwinds. That's a high bar. So while the growth story is real and strong, the downside is big, and if you're looking for deep value, I'm afraid the train has already left the station. What do you think? Let me know down in the comments, and don't forget to follow us for more analyses like this one, and I will catch you in the next one.